Last week, we saw mortgage rates stabilize just above 7%, offering a brief respite in what's been a volatile market. But with big reports on the horizon, like Tuesday's consumer confidence report and Wednesday's core PCE inflation, could this be the week we finally see some relief? Or will rates climb even higher? Plus, with housing data painting a mixed picture, what does it mean for buyers, sellers, and refinancers in this market? If you're looking for answers, you are in the right place. In today's video, I'll break down what last week's trend mean for you, preview the upcoming economic data that could shake up rates, and give you actionable strategies to navigate this tricky market. Whether you are wondering if it's time to lock in your rate or hold for a dip, I've got you covered. And later, I'll share a key market trend that might surprise even seasoned experts. It's a signal that could reveal where mortgage rates are really headed next. So let's dive right in. This past week brought a mix of housing market data and labor market updates, all of which helped shape mortgage rates. While rates started the week slightly higher, they stabilized as the week progressed, offering a small measure of relief for borrowers. So let's break it down. On Monday, we saw an unexpected boost in Home Builder Confidence Index, which jumped to 46 from last month's 43, beating the forecast of 42. This marks a positive signal from home builders who are feeling a bit more optimistic despite high rates. This optimism, however, wasn't enough to hold rates steady, as the average 30-year fixed-rate mortgage edged up slightly to 7.08% from the Friday's close of 7.05%. Then Tuesday brought mixed housing market data. Housing starts came in lower than expected at 1.31 million, down from the previous 1.35 million, reflecting a slowdown in new construction activity. Meanwhile, building permits, a forward-looking indicator of future construction, registered at 1.416 million, slightly below the forecast of 1.43 million and the prior month's 1.425 million. These numbers suggest that while builders remain cautiously optimistic, they are scaling back plans slightly, likely due to ongoing affordability concerns for borrowers. Mortgage rates responded by ticking down slightly to 7.04%, offering minor relief. As promised, here's the surprising trend I mentioned earlier. Despite mortgage rates hovering near 7%, home prices are still rising in many markets. Let's talk about why this is happening and what it means for you. As mortgage rates climb, builders aren't just slowing down, they are actively pulling back on building permits and new construction activity. Let me show you what I mean. This chart shows the inverse relationship between mortgage rates and building permits. As rates rise, affordability drops and builders respond by scaling back on new projects. But there's the kicker. They are not just reacting to lower demand. Builders are actually cutting back strategically to limit supply and keep home prices stable. It's a calculated move to protect the value of homes on the market. Now look at this broader trend. Over the years, you can see how building permits have closely mirrored shifts in housing starts. What's happening now is more than just a reaction to the current environment. It's about maintaining balance in the market. By reducing construction activity, builders are signaling confidence in the long-term value of homes, even with rates above 7%. Understanding this dynamic helps us read between the lines of the housing data. Builders are playing the long game, betting that limiting supply will ultimately stabilize home prices even if affordability remains a challenge for buyers in the short term. So, if you're in the market, keep an eye on these supply trends. They might just hold the key to whether rates start easing in the new year. Now, how does this affect you if you're buying or refinancing? Fewer new homes being built could keep prices higher than expected, even as rates fluctuate. That's why understanding these trends is critical for your financial decision. Think of it like a coffee shop raising prices on limited drinks. They would rather sell less but keep the price high to preserve their bottom line. Builders are doing the same with housing supply. Hopefully that makes sense. All right, so now moving on to the economic data from the last week. Thursday was one of the more eventful days of the week. First, the initial jobless claims came in better than expected at 213,000, signaling a continued resilience in the labor market. At the same time, the Philadelphia Fed Manufacturing Index surprised to the downside, dropping to minus 5.5 from last month's 10.3, raising concerns about regional manufacturing activity. We also got the existing home sales report for October, which showed sales rising to 3.96 million, an improvement over previous month's 3.83 million. This uptick suggests that buyers are still willing to make moves even at elevated rates. By the end of the day, mortgage rates stayed relatively steady, ticking down slightly to 7.04%. The week wrapped up with stronger than expected data from the S&P Flash PMIs. The services PMI jumped to 57.0, well above the forecast of 55.0, signaling robust growth in services sector. Meanwhile, the manufacturing PMI held steady at 48.8, still indicating contraction. However, the consumer sentiment index came in weaker than expected at 71.8, missing the forecast of 73.5. This reflects ongoing concerns amongst consumers about inflation and economic stability. Mortgage rates ended that week flat, holding steady at 7.03%, capping off a relatively stable week compared to recent volatility that we have seen in previous weeks. Last week's data highlighted a mix of optimism in housing and strength in services, tempered by cautious consumer sentiment and slower manufacturing activity. Mortgage rates showed resilience, managing to just stay above 7% but avoiding any sharp increases. This stability offers a small window of predictability for borrowers. This week is lighter on scheduled economic events due to the Thanksgiving holiday. But we will still have several key reports early in the week that could influence mortgage rates. Let's break down the highlights. Tuesday kicks off with the S&P Case-Shiller Home Price Index for the month of September. This report tracks home trends across 20 major cities and is forecasted to rise around 5.2% year over year, maintaining a steady appreciation. If prices come in stronger than expected, it could signal persistent demand despite higher mortgage rates, which might pressure rates upwards. Later in the morning, we'll get the Consumer Confidence Index for the month of November. It's forecasted to climb to 113.0, up from 108.7 in October. This is a critical gauge for consumer sentiment, and a higher than expected reading could reinforce the idea of economic resilience, potentially pushing rates higher. Finally, the new home sales report for October will give us fresh insights into the housing market. Sales are expected to dip slightly to 720,000 from 738,000. A softer number might hint at some cooling in the housing market, which could ease pressure on rates. Wednesday is packed with data, and the most important reports to watch include initial jobless claims, which are expected at 215,000, just slightly above last week's 213,000. If claims come in lower than expected, it would signal continued labor market strength, which could keep rates elevated. Durable goods orders for October are forecast to rise by 0.5% after last month's decline of 0.7%. This report is a key measure of business investment. Stronger numbers here would signal economic resilience, potentially putting upward pressure on rates. Core PCE inflation, the Fed's preferred inflation gauge, is forecast to rise 0.3% month over month, bringing the year-over-year figure to 2.8%. If inflation runs hotter than expected, it would bolster the case for tighter monetary conditions, likely pushing mortgage rates higher. And lastly, the pending home sales report for the month of October is expected to show growth of 1.8%, a slowdown from September's 7.4%. This could indicate some softening in buyer activity, which might provide a smaller reprieve for rates. With the Thanksgiving holiday cutting the week short, most of the action will happen by Wednesday. Watch for consumer confidence and core PCE inflation in particular, as they will be critical in shaping mortgage expectations for mortgage rates heading into December. This week's data offers some critical insights into the housing market and broader economic conditions. And it all ties back to one key question. Should you lock your rate now, or is it worth waiting for a potential dip? So let's break it down. The decision to lock in or wait depends on your timeline and your risk tolerance. With rates holding near 7%, small moves in the market could make a significant difference to your monthly payments. If you are nearing the end of your home buying process or preparing to refinance, locking in your rate this week could be a prudent move. Tuesday's consumer confidence and Wednesday's core PCE inflation report could drive rates higher, especially if the data signals continued economic resilience or rising inflation pressure. By locking in now, you protect yourself from any upward surprises. If your timeline allows for some flexibility, waiting could be an option. Reports like pending home sales and durable goods orders might indicate cooling activity, which could help ease rates slightly. However, this approach carries risk, as rates could rise unexpectedly if data paints a stronger economic picture. This week's report could provide fresh clues about where mortgage rates are headed next. Whether you are buying, refinancing, or just watching the market, staying informed is key to making the best financial decision. Rates are holding near 7%, and while some relief may be possible, it's critical to align your strategy with your goals. To help you stay ahead, I post daily rate updates from the top 5 banks, giving you a clear picture of what's happening in real time. If you need help with your mortgage, want me to review your loan estimate, or have a question about rates, points, or fees, drop me a comment. I'd be happy to assist you for free. And if you found this video informative, I'd really appreciate if you could hit the like button and subscribe to the channel. It helps out with the algorithm immensely and ensures more people can benefit from this content. So please subscribe now for daily updates you won't find anywhere else, like how to spot rate trends before they happen and stay ahead in this tricky market. Let me know in the comments where you think mortgage rates are headed next. Will they stay above 7%, or are we finally in for some relief? Thanks for watching. I'll see you in the next video.